Hello and welcome to the Stock Market Palantir. Don't forget to subscribe and drop your comments below. All right, let's go watch the analysis.
$53.87. That was a closing price for Hut 8 Corp. That's ticker HUT as of the bell on Friday, February 13th, 2026. A positive move of 5.69% on the day.
On pretty solid volume too, 4 million shares. But looking at that single Friday closes, it's deceptive. It really masks a battlefield of volatility that we've seen all month.
It does. But it sets the context. We are looking at a stock that is consolidating after hitting a 52-week high of $66.07. It's sitting comfortably above its 50-day moving average of 52.39. The technical suggests support is building right here.
Support, or is it exhaustion? If you look just a week prior on February 6th, we saw a surge of nearly 19%. And then what felt like immediately after, on February 5, a sharp decline of 17.58%. That's just whiplash. That is not the behavior of a stable infrastructure stock. That is the heartbeat of a crypto miner.
And that volatility brings us directly to the central tension we are here to discuss today. The market is, it's struggling to categorize exactly what Hut 8 has become. Is it still just a Bitcoin miner, tethered to the violent swings of crypto? Or has it successfully metamorphosed into something else entirely? A diversified energy infrastructure platform that is powering the AI revolution?
Well, that is certainly the narrative management is selling. The whole dissolving boundaries between energy, mining, and high-performance computing. It sounds very elegant in a slide deck.
I argue it is more than a narrative. It's an operational reality. The market is beginning to correctly price Hut 8 as an infrastructure-grade play, something closer to a data center REIT than a miner. Between their power-first strategy and a massive development pipeline, I believe we're looking at a potential 5x valuation increase.
And I am here to argue that the valuation multiples are already stretched, frankly, aggressively high. The market is pricing in absolute perfection for projects that haven't even been built yet. The execution risks, both for that 8.6 gigawatt pipeline and the physical reality of grid constraints, are being severely underappreciated. You are paying a premium today for a theoretical future.
Okay, then let's dismantle the theory and look at the facts. My position is that we witnessed a paradigm shift on December 17, 2025. This wasn't just a press release. It was a structural change in the business. I'm talking about the partnership with Anthropic and FluidStack.
It was a big headline, I'll grant you that, but headlines don't pay the bills.
It's the mechanics of the deal that matter. We are talking about a 15-year lease valued at roughly $7 billion. But here is the key insight I think the bears are missing. It is backstopped by Google. This drastically changes the risk profile of the company. You are no longer relying on the spot price of a hash rate. You have a premier institutional counterparty, perhaps the most creditworthy in the world. This transforms their revenue from volatile mining rewards to predictable, long-term net operating income, or NOI.
Okay, I'd understand the appeal of the Google Halo. It validates the tech, and it certainly helps with financing terms, sure.
It does more than help. It vindicates the power-first strategy. See, Hut 8 went out and secured 8.6 gigawatts of capacity before they even identified the workloads. Critics called it speculative. But in an energy-constrained AI market where power is the new oil, that was the winning move. They hold the power, literally, and now the hyperscalers, the Amazons, the Googles are coming to them.
I'm not disputing that the strategy is logically sound. My issue is the price tag attached to the stock right now. You are paying a massive premium for that strategy today, assuming it all executes flawlessly.
How do you define massive?
Well, let's just look at the multiples. Hut 8 trades at a PE ratio of 27.2. Okay, in the high-growth tech world, that might seem reasonable. But look at the enterprise value to sales ratio. It is sitting at 23.2.
It is elevated, I admit that.
Elevated is an understatement. The industry median is roughly 4.47. You are paying nearly 5 times the industry average for every single dollar of sales. That suggests the market is pricing in two things: the massive nave of the Bitcoin reserves and full credit for future revenue from a pipeline that isn't built. It leaves zero margin of safety for an investor.
I think that EV to sales metric is misleading because it ignores the asset density and the transition they are in. You have to look at the divestiture of the Ontario gas plants back in November of 25.
which reduced their immediate revenue generation capacity. I mean, that hurts the denominator in your sales ratio right there.
But it increased their efficiency. It's an asset-light approach to power generation combined with an asset-heavy approach to digital compute. They're recycling that capital into higher-margin AI infrastructure. This is why their return on invested capital, their ROIC, is reported at 13.44%. That is a very healthy number for a company in this kind of capital-intensive transition.
It is healthy on the surface, but let's look at the quality of those earnings again. In Q3 2025, they reported net income of $50.6 million. On paper, that looks great, but if you dig into the footnotes, $76.6 million of that came from gains on digital assets.
Bitcoin went up. That is part of their business. You can't penalize them for their assets appreciating.
I'm not penalizing them, I'm categorizing them. If you strip out the crypto gains, their operational income, the actual money made from running machines might still be thin or maybe even negative. You are arguing this is an infrastructure company, a stable REIT. But the bottom line is still undeniably reliant on the price of Bitcoin. I mean, if Bitcoin hadn't hit 126,000 in October, would we even be having this conversation?
I think we would, because the market is forward-looking. But you bring up a fair point, which actually leads me to my next one about the corporate structure. They have solved this conglomerate discount issue.
You mean by shuffling the deck chairs?
No, I mean by reorganizing the mining operations into American Bitcoin, the 80% owned subsidiary. This isn't just accounting magic. By isolating the mining volatility into a distinct entity, the parent company, Hut 8 Corp, can be valued like a data center REIT. The parent company becomes a landlord, a power manager.
I am always skeptical when companies use financial engineering to claim they have removed risk. Spinning off a subsidiary doesn't make the volatility disappear, it just compartmentalizes it. The stock still behaves with high beta volatility. We just saw it drop 17% in a single day. That doesn't scream stable infrastructure to me.
That volatility creates opportunity. And the stability is there if you look at the managed services and digital infrastructure segment. It generated $5.1 million in revenue in Q3. That is distinct from mining. Plus, they have the GPU as a service program with 1,000 NVIDIA H100.
$5.1 million is a drop in the bucket for a company with a $5.75 billion market cap. It's a rounding error.
It's the growth rate that matters. That GPU service saw a $2.3 million increase just following a new product launch. This is high-margin revenue leveraging their existing footprint. They aren't just mining, they are providing compute. They're becoming a cloud provider.
Let's talk about where they intend to provide that compute, because your whole 5x valuation thesis really relies heavily on the Riverbend campus in Louisiana. This is the crown jewel of their pitch deck.
It is a trophy asset. You cannot overstate the value of 592 acres right next to a nuclear station.
It is a nice piece of land, but land doesn't compute.
It is carbon-free baseload power. In a world where every tech giant has a net zero mandate, that is a massive, massive competitive advantage. You cannot run a gigawatt-scale AI cluster on wind and solar alone. You need 24/7 uptime. Nuclear provides that. And the math works. The first phase is 245 megawatts. That alone is expected to generate $454 million in annual NOI.
If it gets built on time and on budget.
Look, Jacobs, a global engineering firm, is already on site. This isn't a pipe dream. If they commercialize just 2 gigawatts, that is less than 25% of their total pipeline, the NOI hits roughly $3.7 billion. You apply a standard infrastructure multiple of 15 to that, which is conservative, and the valuation exceeds $55 billion. The math for $29 billion market cap is actually conservative.
The math on a spreadsheet is always clean. Building a $10 billion hyperscale campus in the real world is messy. You're talking about massive execution risk. You're talking about regulatory hurdles, construction delays, supply chain bottlenecks for transformers and cooling systems.
They have partners. They have the capital.
They also have grid and power constraints. This is the elephant in the room that the bulls just ignore. Management has even admitted that electricity demand is outpacing transmission expansion. The U.S. grid is creaking.
And that's why they went to Riverbend. It's adjacent to the source. They bypass a lot of the long-haul transmission issues.
Being adjacent doesn't mean the interconnection is instant. You still need the local utility and the regional transmission organization to sign off. There is a very real risk of delays between now and 2029. And if those revenues get pushed to the right by 2 or 3 years, the net present value of those cash flows just drops significantly.
But that is why the Google backstop is so critical. It aligns all the incentives. Google needs that compute. They have an army of lobbyists and engineers. They will help push through the bottlenecks because their AI dominance depends on it.
Okay, but Google doesn't control the weather, and they don't control local transmission authorities or the NRC. And speaking of capital, let's talk about how HUD 8 is paying for all this.
I'm glad you brought that up. Their capital structure is a fortress. They have a strategic Bitcoin reserve of 13,696 Bitcoin. As of September, that was valued at $1.6 billion.
Holding $1.6 billion in a highly volatile asset is not what I would call a fortress. A fortress is built of cash and treasuries.
It's dry powder. While competitors like Marathon or Riot have to dilute shareholders to raise cash, HUD 8 uses its balance sheet. They borrowed $265 million against their holdings through Coinbase and 2Prime at 8.2%.
8.2% is not exactly cheap capital.
But it is non-dilutive. That is the key. They are protecting the shareholder from dilution. They are using the Bitcoin on their balance sheet to fund the infrastructure that will eventually replace the Bitcoin revenue. It's a perfect hedge.
And we know it can. That infrastructure financing evaporates. Suddenly, their collateral is worth half, margin calls happen, and they could be forced to liquidate Bitcoin at the bottom just to pay back loans.
But we're in a different cycle now. Institutional adoption is here. A crash of that magnitude is becoming statistically less likely as the asset class matures.
Okay, but even if Bitcoin stays flat, you have political risk. Residential electricity rates are up 37% since 2020. There is real affordability pressure on the grid. Voters are angry.
Which is why they divested the gas plants and moved to nuclear. They are insulating themselves from the retail grid.
Voters don't always see the nuance of behind the meter. When the lights flicker, they blame the massive data center next door. We could see data center taxes or regulatory backlash that eats into those projected margins. Even with the federal Genesis mission, local politics can stop a project cold.
I think you are underestimating the impact of the Genesis mission and the Genius Act. I mean, the federal government has recognized AI infrastructure as a matter of national security. We are in a race with China. They cannot afford to let local politics derail these projects.
I agree that the tailwinds are there, sure.
The government is streamlining permitting. HUD 8 is positioning itself exactly where the government wants it to be. They are building American digital sovereignty that provides a level of political cover that a standard crypto miner just does not have.
That sounds very patriotic, and it plays well.
It plays well because it is true, and it is why institutional ownership is climbing. State Street, Thomas Capital, these are major funds that see the pivot. They see that HUD 8 is solving the hardest problem in AI, power.
They see the momentum. But I have to ask, at 23 times sales, have I already missed the boat? The good news is priced in, the Google deal is known, the Bitcoin reserve is known, the pipeline is known. What is the catalyst from here without perfect execution?
The execution is the catalyst. If you believe in the execution, you have not missed the boat. The Google deal validates the thesis, but the revenue hasn't hit the books yet. If they can execute on even a quarter of that 8.6 gigawatt pipeline, the current valuation is a steal.
If is doing a lot of heavy lifting in that sentence.
It's not just hope, it's calculated. That $454 million NOI from just the first phase at Riverbend, it anchors the valuation.
And I look at the gap between capacity under diligence, which is nearly 6 gigawatts, and actual capacity under management. Papers are signed, but until those racks are energized, that valuation gap is pure risk. Delays are the norm, not the exception.
It is risk, but it is asymmetric upside. You are betting on the convergence of the two biggest trends of our lifetime, the digitalization of money and the rise of AI. HUD 8 sits at the exact intersection of those two lines.
I suppose that depends on your time horizon.
I think we can agree on one thing to watch, though. The one metric that will decide this debate.
The interconnection conversion rate.
Exactly. How fast can they turn paper plans into energized racks? How quickly does capacity under development become revenue-generating capacity?
Right. If they can move that 1,530 megawatts of capacity under development into operation quickly, the multiple might be justified. If we see announcements of energized megawatts ahead of schedule, I will reevaluate my position.
And if they hit the Q2 2027 commissioning target for Riverband without blowing the budget, the market will reward them. That will be the proof point.
But for now, you are buying a construction company with a software multiple, hoping the crypto market holds up long enough to pay the bills. It's a brave bet.
Or you are buying the future of energy and AI infrastructure at the ground floor. You're buying the plumbing for the digital age.
That is certainly the debate.
Indeed it is.
If you like this video and want to watch more content like this, then subscribe to the channel. Thanks for watching. See ya.